event today really came out of our conversations with some of our members, and I want to thank our sponsors today, Joe Pizzurro with Breakchain Capital, Brian Shepler with CapBlock. They'll be presenting in a moment about their experiences in the tokenized real estate world, and they've got a lengthy background and history in the real estate world in general, and are now applying their knowledge in real estate to this tokenization world. We also have the privilege of having Representative Salman Bojani with us as well. Representative Bojani is going to say a few words in just a moment. He actually carried our blockchain and real estate legislation this last session, in the 88th session. We didn't have enough momentum to get it passed, but usually that's what happens with a bill when it goes for the first time to the legislature. We will refile that again next session and hopefully push that through in order to get some more state funding for studies and pilot programs all around the state, predominantly with rural counties that really struggle with some of their land administration processes. Representative Bojani is actually also in real estate himself as an attorney and land title, and also a syndicator. So he's raised over $140 million for syndication deals from anywhere from commercial to now mostly focusing on, hospitality. Thank you. So with that, I will bring up Representative Bojani just for a quick few remarks, and then we'll get into the part of the program that you guys came here to hear. Thanks.
Good afternoon, everybody. Hi, my name is Salman Bojani. I'm really honored to be a state representative representing the North Texas area. I was not born here. I was born in Pakistan, but when I moved to America, I was 19 years old and worked at gas stations, mopping floors, cleaning restrooms, and stocking shelves for just $6 an hour. From there, I had hard work and perseverance led me to own my own gas stations later on. 5 years later, I owned 8 gas stations, and I went to law school at SMU in the evening program. And became an attorney, worked at Haynes & Moon, large law firm, and then started my own practice doing real estate transactions. I own a title company. That's why I was able to file that bill. It really makes sense to have blockchain, all the real estate records in blockchain be more efficient. It'll, cost less as well. It'll be great for everybody as well. And then, just got elected to Euless City Council in 2018. Became the first minority ever elected in the history of the city. And last year I got elected to the Texas House of Representatives and became the first Muslim and the first South Asian ever elected in the history of the state of Texas. And now I want to sort of make sure that everybody's represented, everybody has a seat at the table, and trying to make sure that, the business, especially having that business background. I've been on both sides of the fence, right, with the being an employee and now an employer. And now as a state representative, I think there's a lot of power in making sure that everybody has a seat at the table, everybody's represented, and I can do a best job. So feel free to reach out to me if there's anything that I could do from the state, from the Texas Capitol. We're not in session right now. I've been in Austin for the last 6-7 months, and now I'm catching up back at work. Like Lee said, I've raised $140 million. I've got a lot of investors that I'm now sort of getting back to, letting them know. If there's anything I could do, reach out to me, get my card, and let me know how I can help you all. Thank you very much.
Okay, at this time, I'm going to bring forward our presenters today. Again, we're grateful for their sponsorship of this event. So Joe, go ahead and come forward, and Brian as well. We are going to have a presentation and then a discussion and have a Q&A afterwards. So be considering your questions, because you're going to be able to ask these gentlemen those questions in just a moment. So join me in welcoming them to the front.
Hey everybody, does this work? Very good. I'm Joe Pizzurro. Glad to be here. We're here to talk about a little bit about real estate and tokenization. What that means and why would we want to do that. But first, a little bit of background on myself. So I started investing in apartments in 2019. What was the reason I chose to do that? So like many, I was raised middle class, and we were taught, go to school, graduate, get a job, save your money in a 401k, and retire at age 60 and live off of your Social Security and 401k money. I wanted to maybe change that a little bit for myself. It's one of the reasons I named my company Breakchain. I wanted to break the chains and achieve financial freedom. So I started investing in apartments. A little bit later, self-storage as well. I also started investing in cryptocurrencies. And I wanted to educate myself on blockchain. I believe it's going to be something in the future that changes the world, to be honest. Similar to in the 90s, where we saw the internet, we saw, everyone moving online. We saw companies moving online. Everyone had a .com. Everyone had an email. I believe the same thing is going to happen with blockchain. Every company will move to blockchain. They'll have their own token. This is what I believe. So that got me interested in learning about blockchain. Ironically, during my education, we had a project. We had to simulate creating a cryptocurrency. So I actually took that idea and implemented it in real life. So I have a cryptocurrency token. As you can imagine, there's thousands of these things, and most of them are worthless. So how do we get that to a state of relevance? So what I believe is it's got to be backed by something. Otherwise, we got to solve that problem. Our current monetary system, our money is not backed by anything anymore. If you guys, I don't know if anyone remembers this, but before the 70s, you could exchange a dollar bill for gold or silver. Now it's just fiat currency. So on the actual dollar bill, it would say redeemable in gold or silver. It says now Federal Reserve note. So I think in order for cryptocurrency to become mainstream, it needs to be backed by something. So my idea was tokenized real estate. And so that's something in the future that we can talk about at another topic, but that's just some of my background. But I wanted to talk a little bit about real estate. So I invest in multifamily and DFW. So you might imagine, well, is now a good time to invest, given the inflation, given the interest rates? In DFW, with all the population growth and job growth, it's still a good investment. Sales have been up year over year. There may be a little bit down this year. Rents are still pushing year over year. So it's a good market for real estate. What we do with these properties, our goal is to try to add value and then try to flip them as quickly as possible and cash out our investors. Well, sometimes there's challenges where, for example, what's happening right now, a lot of these properties, as you can imagine, aren't cash flowing as well as they would normally be due to the higher interest rates. So if I'm an investor and I want my cash flow, and that's okay, if I want cash flow, I'm not cash flowing right now. Is there a way to pull out of the investment? Well, typically no. Your investment is locked in for several years until they sell the property. So that's the way to cash out your equity. So what we'll talk about in a minute is how does blockchain allow more flexibility and more increased liquidity for investments. But really what we're trying to do is really just add value. The difference between commercial real estate and residential is valued based on comps. So the market totally dictates the value. So in commercial real estate, we have the net operating income divided by the cap rate. So we have some control over forcing that net operating income. We can actually increase value even during a time like this when values are dropping. So for example, and one of my partners is in the room, Brandon. We bought a property a year ago. If we would have not done anything and just sat on it, we would have lost money by now. But we have increased the NOI over 50% and actually raise the value of that property. So that's what we try to do, and we do it through syndication. So we will literally create a company that owns the property, and then there's another LLC that whoever the deal sponsors are, we sit in that and we manage the property LLC. The investors invest in the property LLC as really just buying shares of ownership in a company. It's almost like buying stock. So they own a share of ownership in the company that owns the property. And that's really the model we use. And so what we're looking at doing now is how do you take that model and put it on the blockchain? And it's essentially the same thing. It doesn't really change. The difference is your ownership of equity is in the form of a digital token. or tokens. And you have the ability, you have a little bit of added benefits. So first of all, why tokenization? So I first heard about this in 2018. The picture here is the St. Regis Resort in Aspen, which was one of the first assets to be tokenized. So I saw this and thought, I want to do this someday. And I eventually met Brian. You're going to hear from him soon. He's developing a tokenization software. So what are some of the benefits of tokenization? So the two main benefits are increased liquidity and flexibility, among many others. So for example, what I mentioned earlier, if you're invested in a deal and you want to pull out your equity, some ways to do that really are sell the property or do a cash out refinance. And there are some investors out there that they will want to do a cash out refinance solely for pulling out equity, even if it doesn't make sense to refinance, especially at a time like right now. Why would you want to refinance if you have a lower rate right now? If all your reason is to pull out equity, you can do that with the tokenized shares. You're able to sell a portion or all of your tokens. You could sell them to another limited partner within the deal. You could sell them to one of the general partners. You could sell them to an outside investor. And that brings the other components, the flexibility, where an outside investor could get into the deal after the raise is over. So sometimes there's only a limited time where you can invest, and then you can no longer accept investments. So it's more flexible, where investors can get in and out of deals throughout the holding period without waiting for the asset to sell. And Brian's going to share a little bit more about that as we go. So essentially what we're doing here, we're trying to get the word out about this. It's something I believe in, it's something Brian believes in, and hopefully by the end of today, it'll be something you guys believe in as well. Thank you. Yep.
All right, test, good. Thanks, Joe. And thanks to TBC for helping put this on, and to Ryan and his team for the media and the technology. All right. So anything I present today is my opinion. I'm not a lawyer and not an investment professional. So it is my opinion. And don't take anything I say as investment advice or opinion of law. A little bit about me. I've been in the software industry for 30 plus years. Co-founded a company many years ago. We had a successful exit a few years ago. And since then, I've been looking for something to do in the software industry. Been investing in multifamily for many years as well, mainly as a GP and LP. Okay, so for today, we're going to go over these slides pretty quickly, hopefully provide a good basic high-level understanding of some of the main topics in tokenization, and provide you with a little more information so that when you leave here today, you kind of have a better understanding of what this does, what the technology does, what it provides, and if you might want to use it going forward. So we'll talk about securities, we'll talk about blockchain technology, we'll touch on cryptocurrencies, smart contracts, talk about security tokenization a little bit more, and then a final high-level example of commercial real estate tokenization. All right, so security basics, for anybody who's been involved in the syndication model, you're well aware of all the SEC rules and regs you have to follow. There's a lot of exemptions that you can also adopt. So when you have basically a security means you're presenting an investment, somebody's investing with you, and they expect to make money. It's as simple as that. When you do that, you have to follow the rules and the regs that are in place today. Tokenization does not eliminate any of that. You still have to follow all the rules and regs just as they exist today. Tokenization simply provides a digital wrapper around the investment itself. So blockchain. Blockchain is the underlying technology that will power the tokenization. Blockchain is not a brand new technology. It was first proposed and a lot of testing and implementation done back in the early 90s. Simply said, it is a distributed database. It exists on many, many computers. Bitcoin, for instance, has hundreds of thousands of nodes that actually run the blockchain. They all have the same copy of the data. And that's what gives it the security that no one entity can change the data. It's transparent. That means you can write a program, go in and look at every record in this distributed database. So nothing is hidden. The data is immutable. That means once it's written, it can never be changed. So transactions live forever. And the data lives forever. So it has its purposes, and then there's some applications that are tailored towards the blockchain, and there's some applications that really don't make sense to use blockchain technology. And as it exists today, it's used mainly with ledger type transactions. Bitcoin's a great example of that. It also is used to implement all the cryptocurrencies that you've probably heard of, the thousands that are out there. Cryptography plays a very important role, and it secures the data. Stablecoins. So stablecoins are a type of cryptocurrency. The unique features of stablecoins are that they're tied to a stable asset. It's usually the US dollar or gold or something else that is fairly stable. And the reason that these came about is people wanted to use cryptocurrencies as real currency. But imagine using Bitcoin, and one day it's at 60,000, and the next day it's at 16,000. A few days in between, but you get the picture. So the whole idea of a stable coin is it's worth $1 the day you buy it, and it will be worth $1 when you need to use it. So it gives you a little bit of security in knowing that you can participate in the cryptocurrency ecosystem and not lose intrinsic, value in your cryptocurrency that you're wanting to keep and to save. There's actually two types of cryptocurrencies. One is it achieves its stability by having a backed asset. So that, like I said, gold or dollars. So the USDC is a good example. They actually will buy US treasuries. And they have a large, very sophisticated management team that will actually make money off of that. But it secures your cryptocurrency. There's other cryptocurrencies, stable coins, that are algorithmic based. Now those are not as stable. They can fall prey to attacks. And there's been several examples of that. Luna, I think, was a good example of that in the last few months. I'm not sure how long ago it was, but it basically collapsed. So two different types of cryptocurrencies that are stable coins. And there we go. Smart contracts. So smart contracts are how you interact with the blockchain. Smart contracts are programs. That's all they are. There's a specific language that you write a smart contract in. and the smart contract actually runs and interacts with the blockchain. So remember, the blockchain is the database, the smart contract is the program. And so that's how you implement functionality. So most of these cryptocurrencies you see and you've heard of, they are actually implemented by smart contracts. And that's going to be very key in tokenization. So tokenization will make use of one or more smart contracts to provide the rules and the requirements that allow you to operate that token. And again, these smart contracts, they exist in the blockchain. When you create a smart contract, you actually load it into the blockchain. The blockchain is all visible, so anybody can go look at the smart contract and look how it's executing. That's how some of these smart contracts will get corrupted, or they'll cause them to break, for lack of a better word. They'll find bugs and they will attack them and steal money. Get into more of that. There's many hours of conversation that can be had there. But the main thing to understand is a smart contract is just the program. It contains the code that runs the tokens. So smart contract examples, maybe I'm mentioning a few of them: financial derivatives, services, purchase agreements. Security tokens are a big part of that as well. Again, the purpose of a smart contract, you've heard this term, a trustless environment. What that means is there's no one party that you have to trust in order to engage in business in the blockchain. All right, so security tokenization. Security is a financial instrument as it exists today in the real world. Stocks, bonds, REITs, loans, companies, private companies, public companies. Security tokenization is the process in which that asset is divided into shares if it's not already in shares, and then represented as digital tokens on a blockchain. So the example that Joe gave with his syndication, he created a syndication. There's two different types of shares. There's A shares and B shares. A shares were equity. B shares were probably granted shares for the general partners. Those are share types that can be represented with security tokens. The security tokens have their own symbol. So, BTC or ETH or whatever, your favorite crypto might be. They all have their own symbol. As you tokenize an asset, it will have its own symbol as well. So if your asset, your apartment complex, has 10,000 shares, you're going to have a token unique for that asset, and there would be 10,000 instances of that token that can be bought and sold amongst users. Okay, so the capital stack. You hear that, you may have heard that term before. It's representing the different ownership levels within a real estate investment. So at the very top is your common equity. This is your LP. This typically is all of the equity in a deal. Then you might have preferred equity, then you get into the debt. Mezzanine debt is just a second level of debt, secondary to the senior debt. Senior debt is usually the partner that puts in the most money. And I say partner, it's usually a bank or a lender. They are your biggest partner in a deal, right? So these are the different levels of the capital stack. Every level can be tokenized. Typically, it'd be the common equity. You have common equity and you have senior debt. Almost always you have that in any multifamily deal. Those could also all be tokenized. Okay, so when you tokenize an asset, it's important to understand that the underlying rules and regs don't change. Tokenization does not give you a free pass to go do things that you shouldn't be doing in the real world today with regards to asset management and buying and selling and raising money. The tokens that get created can be listed on a public marketplace or they can be listed in a private marketplace. There's two different places. There's different reasons to use either of those. There's different requirements. In addition to the requirements, there's different levels of money that's required. One is more expensive, but you have you're basically opening it up to the public to invest and to buy your tokens. One is private, and it's a smaller, more select group of people who are able to exchange, buy and sell tokens. Software plays a very big role in the implementation of the tokens and in the environment, the framework that these tokens are offered. So as a manager of a deal or a sponsor of a deal, you need to manage your investors, you need to manage income, you need to manage distributions, and you need to ultimately manage the disposition of the asset. All these can be done with software. The tokenization piece provides a way to tokenize the equity in the deal. That's a small piece of all the functionality that's really needed to provide this framework or this environment in which investors can buy, sell, and sponsors can advertise, raise money, and run, manage, operate their deal. The software's platform can provide the KYC, the AML that's needed to onboard investors, and also provides the mechanism whereby these users will interact with each other. Okay, so as Joe mentioned previously, there's some benefits of tokenization to both the LP, that is the equity holders, and the GPs, or the sponsors of the deal. Liquidity is probably the number one benefit. Most of these deals, most real estate deals today that are offered are private. You can't get in them. You can't go buy a share of Jerry's World, right? If it was tokenized, then yes, and it was offered on the marketplace, you could go buy. Liquidity means the current investors can sell some or all of their equity in the deal, their tokens, realize their profit, or maybe in some cases just get out of the deal and then move on to something else. Why would you want to do that? Well, maybe the GP enjoys this property that has been tokenized that you're a part of and doesn't want to sell. In today's world, in order for you to realize your capital gains, you have to sell the entire property. Now, with tokenization, you can sell your shares, either in a marketplace, public, or private. The cap table management. Once you start this process of being able to buy and sell tokens, equity in your deal, you need to be able to manage the cap table. The cap table is nothing more than who owns the tokens. And that's something that is built into the smart contracts, built into the software. And at any one time, you can get an exact representation of the cap table. We have the transparency. You can go on blockchain. At any time, you can see all the transactions for a particular token. You can go to your account if you have tokens, and you can see all the transactions you've done. The efficiency goes back to the software side of things. The software makes these transactions much more efficient. In today's world, you can actually trade in and out of a deal. There's certain, obviously if you think about what happens with say a death, right? An equity holder in a deal passes away. Well, that requires basically changing your cap table today. And that's possible, right? It's built into all the operating agreements that I've seen. And there's provisions to do that. It's a little bit cumbersome. By tokenizing, that becomes much more fluid and much easier to handle that. The one other big benefit that I don't have up here is for the GPs and for the sponsors of the deals. The way a lot of the real estate deals are structured is you make money two ways. One is cash flow, which are just basically quarterly distributions on the profits from operating the business. The other is from capital gains, and that's when you sell. That is primarily, in recent years, has been much, much larger. Your capital gains have been much, much larger than your quarterly distributions. The GPs generally structure the deal, so they get an override of the profits. So the more money, the higher the capital gains, the more money the GPs will actually make. So in some cases, it could be 20%, and they call it an override, or it could be 30%. It just depends on the deal that is structured. Again, that isn't realized until the entire deal sells. So 300-unit apartment complex, they hold it for 10 years, sell. That's when that capital gain is realized. That's when it gets distributed. That's when a big chunk of money goes back to the GP team. In tokenization combined with the software environment that it runs in can handle this capital gains and the override on every sale of a token. So one investor realizes their capital gain 1 year into the project. When it's sold, the software, in combination with the tokens, when it's exchanged to the new equity holder, calculates the capital gain, calculates the override. The override then goes back to the GP. The remainder of the capital gain goes to the investor, the initial equity holder. So that's a big benefit for realizing capital gains from a GP standpoint. For those of you who might be GPs, that should be, bells should be going off right now, right? Okay, so this was just a high-level overview of the technologies and the benefits of tokenization, kind of how it works. There's a lot of details. There's a lot of nuances in the different deals, and there's a lot of decisions that have to be made along the way about how to tokenize, what you tokenize. There's different shares that could be tokenized. You could do a partial tokenization of some of the equity. You don't have to tokenize the entire capital stack. You might want to just tokenize debt. You might own a property outright, cash. Well, set up a structure so you actually will set up a debt fund, if you will, tokenize the debt, and have your equity partners over on the other side, two different entities. Fixed income on the debt side is tokenized. distributions every month, like clockwork. The other side, the equity side, works just like a normal multifamily investment with cash flows that get distributed quarterly and then capital gains at the end. Again, liquidity and the efficiencies realized because of the tokenization, very important features of that. And many, many other nuances that are involved, but I think that's a fairly good broad introduction into tokenization. And hopefully we can have further conversations. Okay, thank you.
Thank you, gentlemen. Y'all want to come up for the panel? So we're going to do a Q&A now. I'm going to moderate it. I'll throw a few questions out, and then I'm sure just take questions from you guys. There is a microphone, so please wait for the microphone to ask the question, even if you have a loud, booming voice, because for the sole purpose that we are recording this, and we want to make sure to capture your question in the recording. So is Michael Wade here? He was going to join us in the panel. If not, we can drive on without him. Okay, we're going to drive on. So there's two things that I think we need to distinguish before we jump in. There's the tokenization piece, and then there's the blockchain for land administration and title side. I think for this conversation, let's stick to the real estate GPLP tokenization, because that is really near at hand, right? On the land administration side, you're dealing with counties, county clerks, state governments, and we're actually moving title on blockchain. That's something that I think we all aspire to see, but is maybe a few more years out than the tokenization piece, which is actually here on us right now. My first question, and I'm just going to ask one actually, and then open it up to the audience. My first question is, we've seen this use case be touted for many years, and yet there's silos of different ATSs, alternative trading systems, where these assets on the secondary market are trading. Do you guys expect there to be a consolidation of these marketplaces so that if someone's looking to buy and sell, they can just go to one website instead of having to see like, oh, these 5 properties are here on Toko, and these 15 properties are here on T0, and these others are on Securitize? Is that where we're headed, or are we still going to see silos for years to come?
I mean, without answering it technically, I think likened to the World Wide Web, that at some point that would be possible if everything's on blockchain. And there's different blockchains, so it would have to be a multi-chain solution. But that's what I would believe that is definitely possible.
I would agree. I think it depends on the standards. Technology standards need to be agreed to, and the smart contract interfaces need to be standardized so that each exchange can interact with the tokens in the same way. It's interesting, you're talking about a distributed model and distributed exchanges, but if you think about the way assets are traded today, there's one exchange. There's NASDAQ, and
Dow.
the Dow and various other places you go. It's not distributed today. So it would represent a good move forward. There's a lot of things that have to take place as far as identification, the KYC, AML. When you log into these different exchanges, they have to know who you are.
Yeah.
They have to verify who you are. And they have to transmit that information back to the token provider so that they know who you are. So there's a lot of work to be done, but I think eventually it'll happen.
Maybe that's a good business idea for aspiring entrepreneurs, is to build a platform where you're pulling data from a bunch of different ATSs, you're aggregating it, and then you direct the user to that ATS for their KYC, but you can still see all of the asset. I mean, I don't know how the ATSs would feel about that. I think they all want to, try to conquer the market. But
they do. They all want to be the king in it.
Yeah, they all want to be the new NASDAQ.
They see all the money that's being spent today with listing. The cost of listing stocks is absurd.
Yeah.
You know, and they want a piece of that.
And there's so much more. I mean, if you had give me a second to Google it, we could find the ratio. But private assets it's just a massive asset class relative to publicly traded assets. So I did say I was just going to ask one question and let you guys open it up. If you do have a question, grab a microphone.
Got one for Dan.
Awesome. Yes, sir. Mr. Washington.
Yeah, thank you, Lee. My name is Tom Washington. I was listening eagerly and heard that you can have a real estate token and have a fractional interest in a real estate interest, and you'll get cash flow and other benefits from that, including capital gains. Is it to the point where you'll get K1s so that you can actually turn these K1s into the IRS? Are they recognizing token ownership now as the kind of ownership that they would tax?
Yes. A token ownership is exactly like equity ownership today without tokens. There's no difference. The K1s will have to be generated and distributed to token holders. I think it's up to the GP or the owner, the sponsor, to decide who is going to get K1s and how to actually determine, the ownership. It's challenging, but all the data is going to be there in the blockchain. So, yeah, K1s have to go out. That's a definite.
I received a K1 from one of my tokenized investments. I've just used T0, but I know there's several other platforms like Toko and Securitize. So it's a good question, Ron.
Thank you. Is that technology working right now for you?
Yes.
So it is actually, so how do you go about the public offering side, like being listed? Does that need to be registered as a?
So what I am focusing on is not the public side. I'm focusing on the private side. So my ideal customer is a GP that has many deals and has a Rolodex of 5,000 to 10,000 potential investors. That allows us to deliver the technology, deliver the platform to the investors, and not have to worry about a lot of the problems that are brought on by public access. So that's the easiest path forward to prove the technology and provide business value.
Yeah, if you wanted to go that route, you wouldn't have to work with an ATS, an alternative trading system. But if you do want that public market access, then there's a litany of SEC requirements. And someone correct me if I'm wrong, but most of these ATSs require accredited investors for the vast majority because they're Reg D offerings. Mm-hmm. I know there is a way to do Reg A offerings on securities token offerings, but it's less common. I'm not familiar with very many Reg A offerings yet. So
that's crowdfunding, right?
Mm-hmm.
Yeah.
That's true. Crowdfunding for projects less than $5 million. I think that's the $5 million is the current.
It is a fairly low.
There's a couple
bar,
of different metrics in there depending on how many people and the size per person, and then it kind of fluctuates.
Tiers out, yeah.
Are there any syndicators in the room by chance? Interesting.
Okay.
Because I think Brian's software would be likened to an investor portal, sort of, mm-hmm. right?
And that's something that we realized very early in this process is you can provide a tokenization implementation and tokenize assets, but without all the other supporting software and features, and it's really not going to be of much benefit. So it really has to be part of a much bigger environment of software, tools, and technologies.
And it is an interesting concept because pretty much everybody has been talking about moving their asset for secondary trading onto an ATS. But there are legal opinions out there that talk about a closed network of syndicators that they can trade those assets between the syndicators. Now, you may have a network of your LPs, 10,000 LPs. So that's a pretty broad network. Your network when you're on an ATS is millions, but there's a difference in compliance and regulatory costs and challenges when you make that leap. So I think this unique concept of finding GPs and using their network of LPs is really not one that is touted as much in the media around this space.
And the public exchanges also have a problem. They have to drive traffic there too.
Right.
So you still have to advertise your deal until the time at which these exchanges become public household knowledge. And whenever you want to invest, you just go there and they'll show you the investments. We're not there yet. We're nowhere close.
Hi, I'm
Mike?
I'm Mike Mills. I'm a mortgage lender, actually. I'm curious, with commercial real estate kind of being a little bit under stress these days, especially in the office space and that kind of thing. There could be a lot of opportunity over the next several years with commercial real estate specifically, where new investors coming in with a new type of way to get involved, because some of these property values are going to go down. The lending is going to get tighter because the rates are going up. These loans are going to have to be reset. Have you guys structured or come up with, obviously we have the trading on the exchanges, but just an educational campaign? Because I think the hardest part about this type of technology is helping people understand it. And because the entry point is so much lower than it would be for a standard syndicate, where you don't have to put quite as much money in, but could still be involved, to get to that lower level investment, to recollateralize some of the debt, to reset some of the properties. Have you guys come up with a strategy to try to reach the masses, as it were, to try to get the information out?
Well, that's what this is starting to be. Hopefully, we'll build on this. But yeah, exactly like you said. Sometimes it takes a while for folks to hop on the bandwagon, and there's those who, they're old school. They don't want to do this digital stuff, and they'll wait till everyone else trips and falls and figures it out first before they try it. But I think it helps to having someone that from the real estate world like myself, who sees this and can help translate for the other real estate professionals. But yeah, I think this is the first step, and where there'll be more of these and other events in trying to accomplish that.
The big challenge I see is with the investor and getting them comfortable to use crypto and wallets. And I mean, it's scary right now. If you lose your key for your wallet, it's all gone. And so I feel like the path forward is going to be more trusted custodial wallets. But you still need to educate the investor and educate them on cryptocurrencies. So ideally, what we would have is an offering from a sponsor. All the funding takes place in crypto from the investors. The purchase takes place in crypto. Find a lender who wants to do that, right? And you get more and more of the currency actually in the crypto world.
Sort of with stable coins, probably.
That's why stable coins are such an important part of this. But the more of the fiat money that comes into the crypto world, the stable coins, or the tokenized assets, if you will, then as you get distributions in stablecoin, USDC, you keep that in your wallet, and eventually that gets big enough to where you can invest in another deal with your crypto while you're still getting distributions in crypto. So think of the money flow that happens today in your bank account, and you just move that into the crypto world. The money is the same. The amounts are the same. It's just the vehicle that's being used is no longer a dollar. It's actually something else, some type of crypto. Once you have it there, once you have that currency in the crypto world, now you can go back and forth easily. Once you start using that method, you'll be amazed at how quickly, how easily it is to transfer the currency around. And another benefit is you don't have a bank sitting there, holding your money, which they've already lent out 10 times, right?
Hey, my name is John West. I consult in the blockchain space, and good presentations, real estate tokenization, very cool. But I probably have a dumb question, maybe to back us up. So we've been tokenizing assets literally for decades, right? Stocks and companies and bonds. And why has it taken real estate so long to tokenize? Why didn't it? It can't just be the technology. There had to have been something else that was blocking it, or it wasn't moving forward, because it could have tokenized on, the same systems that stocks tokenized on or bonds tokenized on. What took real estate so long?
Real estate's very slow. I don't know.
It's not a tech-heavy sector. We've tried in the real estate space for the better part of 20 years to launch tech-heavy solutions. Look at the brokerages. I mean, go look at the software tools that brokerages are using, even the ones that tout themselves to be kind of, best in class. They're just slow movers behind the curve on technology. It's just one of those industries. Look at who it's made up of. Tons of kind of, part-timers, and they do a little of this, a little of that. And I just don't think there's ever been a real big takeoff focus of people bringing these type of technologies to the space.
Up till now, the cost has also been an issue. I think if you look at tokenizing a $5 million asset, the cost of doing that in the past would not make sense. Now, with the advancement of software and the tools and technologies, now you can do that. There's a lot more automation. The costs have come down. So I think that has something to do with it.
And REITs were sort of a halfway point, right? I feel like REITs were that was the technology of tokenizing almost.
Yes, I'm interested to probe a little bit on. You said we've been tokenizing companies for years. What do you mean by that?
Selling stocks.
Okay, so I would say we haven't been digitizing them. We have been tokenizing them. If you go look at the details of settlement of sales of stocks, it's crazy. And the tokenization and blockchain, it's immediate settlement. And so that, I think there's a lot of benefits. You will see the stock exchanges start to explore this technology. I think there's been some articles in the news lately. Chase might be settling billions of dollars worth of some of their products actually on blockchain already. And that hasn't gotten a lot of press, though.
Hello, my
Yes,
name
sir.
is Oscar Hidalgo. I'm a GP and operator, and I work with a lot of investors. And I feel like a good question that I feel an investor will have is if the main benefit is liquidity, how do you compare this to owning shares on a REIT or maybe buying stocks on a bigger real estate investment fund that do offer a level of liquidity? So how do you justify the risk of going into a blockchain compared to that?
Well, I think it's more liquid. So you have increased liquidity by being able to, like Brian mentioned, selling a portion or all of your tokens during the holding period. And also for GPs to realize their override during the hold period as well. I think I agree that that's probably the main benefit.
And REITs have increased, the fees
Yeah.
and what you're taking, what the fund manager is taking is significantly greater.
Tokenization allows a granularity of investing in a single property. And that's what REITs don't. Like BlackRock, they've got a huge multi-billion-dollar REIT. You just put money in there. And then they go buy shopping malls and other investments. And then just like earlier this year, people wanted out. And they said, well, nope, no more redemptions. And so, just because it's a publicly traded REIT doesn't mean you can get your money out. If it's tokenized, in theory, there's always a buyer at some price. What is that price? Right? It just depends. If everything's on the way down, at least you've got a way out. That's, why would somebody want to sell at a loss? Well, maybe it's to prevent a total loss. I don't. There's many reasons why people want to sell.
Hi there. Sorry, I wrote my question down and you guys answered part of it, so I'm going to be reworking it while I ask. But a number of the ATSs in the space currently, so T0, Securitize, Figure Blockchain, and a bunch of these guys have been having a liquidity issue quite a bit in terms of there's not as much or as many people buying on the secondaries. And you guys mentioned at the very beginning about how everyone's trying to be king. Do you guys have any solutions or strategies on how to minimize the overall slippage in your secondary markets? And is there some sort of market making style solution to make sure that as people are trying to buy and sell, that it's liquid enough? Because there's a chicken and egg problem there, right? With a lot of this stuff. Even Figure Blockchain that has $1 billion in inventory is not able to do even a small amount of volume to justify the amount of inventory it has on the token securitization. Sorry.
Well, I think the focus at first would be more on the private marketplace until such a time when because like you said, the public marketplace is not there yet, I don't think. I know I think what Brian's focus is.
And Joe, when you say public, you don't mean the public markets, you mean public ATSs for private assets. Yeah.
So there's some interesting things there. There's going to be some rules and requirements that have to be followed for when people can sell, when investors can sell. Like I mentioned, depending on your investment vehicle you set up, the investors may not be able to sell for 6 months or a year. Yeah. And we're starting to engage counsel because, as you can imagine, there's some unique occurrences that tokenization brings about that haven't had to be addressed before. What's unclear at this point is when somebody else comes in, a new investor purchases shares from an existing investor, how long do they have to hold? And is it the same requirements? And so the idea of having large volumes is, I don't think that I foresee having large volumes in individual investments for apartment buildings or businesses. Now, I'm not looking at taking an Apple or an Amazon and tokenizing them. That's right. Yeah, there's huge liquidity there. What you're talking about is trading that might go on that 1 or 2 a month, maybe, until such time that more people become familiar. There's more eyeballs. That's a part of the problem with liquidity today on the public exchanges. There are just not enough people there. People probably just don't know about these marketplaces.
Have you thought about maybe offering incentives to people who maybe don't agree to sell for a period of time or provide liquidity, almost like bad word staking? Both staking their asset that they bought and agreeing not to sell it for a period of time for an increased kind of security structure of the underlying asset, or providing the dollars on the other side and making a piece of the action if somebody maybe just diversifying kind of participation. Maybe you don't even have to buy the asset, you can just provide liquidity for the asset, and then there is some type of slippage that makes up the difference.
Yeah. Well, there's always a counterparty, right? So to provide those things, you have to have somebody willing to take that risk. And so what is that value? We haven't started looking at that yet, but it's interesting. Yeah.
It's a good question.
Hi. I run an oil and gas company, and we spend a lot of time looking at this because it's a strong analogy to real estate. The investment characteristics are a lot the same. But on the liquidity point, how many examples are there? I know you're focused on private, but we've looked at it more from a public perspective, and sort of looked at securities laws exemptions to get it into the hands of accredited investors. And then after the hold period, they can list it on one of these secondary exchanges as long as the GP is willing to maintain the public information requirements that are required for a traded security. But I think the first example I'm aware of is when Elevate Capital listed their interest in a high-end hotel in Aspen. So I think the number of their investors went from, and I think they did it on T0 if I'm not mistaken, but the number of their LPs went from like 10 to 500 right away because they did these fractionalized interests. So yes, they're just LPs, but the GP's got to be willing to deal with the fact that they've now got 500 investors where they had 10 before. The other thing they experienced there was about a 20% valuation uplift. So if you're an investor, it would seem like to me, and this is part of the question we've been asking ourselves, is what is the benefit to the investor? And liquidity has to be one, and that's a hard question to answer right now, as you've acknowledged, because I don't think the liquidity's there. Volume is just not there. There are not enough products listed on T0 yet, not enough products listed on Securitized yet, and we've talked to them a lot about it. But then the valuation uplift, an investor wants to believe that not only can I get out if I need to, hit the sell mouse on my computer, but is there a chance that those LPs, when you fractionalize those interests, will drive the price up a little bit? So not only do I get liquidity, but a valuation uplift. So are there many examples beyond that one of real estate that has been tokenized and that is traded on these secondary exchanges?
I'll jump in here with one quick example. Off of 635 here in Dallas, there's a facility that Market Space Capital tokenized, trades under the ticker MIRA. I guess it's not called a ticker in private markets, but it is on T0, and it's right off of Webb Chapel in 635. I'm not aware of too many in the DFW area, though.
Not either, no.
I think there's less than 5 in DFW that have been tokenized in this way. There could be more tokenized in the way that you're describing, and we just don't know about it.
I think what Elevate did in that case was they floated 20% of the capital.
Yeah.
Right.
What you see done with a lot of public companies traded on traditional exchanges. They're not actually listing 80% of their equity. They just put 20% of it there and keeping the other 80 off. That's
exactly right. I think that's and that's what it was with this facility. MYRA was 17% tokenized.
Hi, Brandon Wong with Guardian Multifamily. I was just thinking through a few different scenarios that might come up and was wondering if either you guys or another entity out there came up with a mechanism to handle this. But let's say, for example, you issue a coin, you have 500, 1,000 potential investors on a larger deal. The first part is, a gentleman mentioned K1s earlier. CPAs are backlogged as it is. A lot of K1s are late. How would you handle issuing 1,000 K1s, or the person issuing the coin handle that? Is there some type of automated mechanism in place for that? And the other question is, if the GP passed away, or the team, there was some kind of catastrophic accident, or they were deemed incompetent, there's usually a mechanism in the operating agreement to where they can be voted and replaced out. So how would you round up 500, 1,000 investors to agree while preserving their privacy? So I apologize for the stack of questions.
Okay. Sounds like a software question.
Yes,
Okay.
yes, it's a software feature.
So let's see, the last one. There's voting mechanisms that can be built around the tokens, because you know who owns the tokens. You can quite easily create voting procedures amongst the equity holders. I'm sorry, what was the first thing?
K1.
The K1. Oh, K1s. So K1s, it requires input from the GL. It requires input from the tax side of things. We have depreciation. There's the allocations. There's a lot of things that go into K1 besides just the ownership, and who, just because you are part of a deal and you own so much of a share, now you have to go back and peel back the operating agreement and find out what is the sharing agreement for the distributions, what's the sharing agreement for depreciation, and so on. And so that does have to fall on the CPA. That's something that they have to go through the GL. They have to go with all their tax planning, and that's something that the tokenization piece does not address at all. Tokenization addresses the ownership and the cap structure. That's okay.
Next question, right? So I've got. So I've got kind of a random question. I hope that's all right. If I own a house and I tokenize it, to get the equity out of my house and kind of increase liquidity there, but let's say that the house burns down, how do I change the on-chain pricing of that house? And what's stopping me from just selling the rest of the equity before my investors find out that the house burned down? Because no, it's like in 2021, someone bought the original Dune book for $5 million. It accidentally burned down. All the investors lost all their money. So, how do I change this with real estate?
I would introduce you to someone here after this that probably has a better answer on that.
I think you got to perfect your security interests in these assets, right? So written into the contract, or there's also Uniform Commercial Code adjustments here in Texas that say that you can perfect your security interest in these kinds of assets, digital assets, virtual currencies, et cetera, so that you have a UCC1 or a filing statement, so that the Texas Secretary of State knows there's a security interest in this asset, even though it's not a typical security interest, it's a tokenized security interest.
How would you change it on a immutable ledger?
You don't necessarily need to change it on the ledger, because when that person tries to send or sell that asset, it'll flag that there's a security interest and it'll point to your token. Does that make sense? So you couldn't sell the house without the investors knowing about it, because that sale would get flagged by the other security interests that have been noted on that asset.
Thank you.
Brian, Christopher Friedel with Texas Blockchain Council. I think you mentioned before it not hitting the news, the information being in the news cycle. So I think Larry Fink said, I believe the next generation for markets, the next generation for securities will be tokenization of the securities. And then the World Economic Forum estimated that 10% of global GDP will be tokenized over the next 7.5 years. You mentioned the friction points being the regulatory framework, also the use of the digital dollars. What do you see as the biggest friction to get to that point where it is tokenized, the intersection between the public and the private markets?
Time.
I think it's people. The people are almost always the hardest part of changing processes, and this could be generational. It may take a generation. We've seen how generations change, and the older generations can't adapt to it, or they don't want to, and so it might be just time. That's you have to be comfortable with the money. I'm sure when we switched over from gold standard to just paper, there was a lot of people that didn't like that. They weren't comfortable with that. Well, then it took a while, but now people are used to the dollar, just a bill. Well, in the last few years, we've seen how it's now worth a lot less. And so it's raising a lot of these the concerns and the general awareness of that. So it does come down to people. I think it's a good point. When we realized that very early on in developing our software, we didn't want to have a requirement that every investor buy into the crypto and buy into wallets. So we built the software in such a way that the users can actually opt out, and it will operate just like they do today. So an investor can be part of the deal, transfer their money and fund the deal just like they do today, wire. They can get their quarterly distributions either through wire or electronic funds. And then when they sell, they get a check in the mail or they get wires. That can all happen with their ownership of a token, and they don't know it. They don't need to know it because they own the token, but they never do anything with it. But they can still choose to be in the investment and still gain all the benefits of it. That, without doubt, that's what I've seen in the past with software, is the people are the problem, and you can't fight it in a lot of cases. So it just takes time.
We have time for one more question.
Can I just add a couple of comments to that?
Absolutely.
Okay, so a couple of the other issues that I see is that we have an educational divide. People don't understand the difference between blockchain as the technology and cryptocurrency. They think they're the same thing. So we really need to spend time educating the public on what the blockchain technology is. And the other thing is you cannot have a platform that's tokenized where people have to come in and figure out how to set up a MetaMask wallet. Right. It's too confusing and nobody wants to do it. Truly good, great technology works in the background. So we've got to create a platform like Schwab where people can log in, the wallet automatically sets up for them, and they can automatically trade, and it happens seamlessly without anybody ever having to worry about a wallet. So I think those are a couple of the issues as well.
I agree completely with that.
It's a great place to end. A lot of building yet to be done, but we're on the exciting forefront of some new developments here. Gentlemen, thank you.
Yeah. Thank you.
Guys, thank you for being here. You're welcome to hang out for a few more minutes and network. I do want to draw your attention to the Texas Blockchain Summit that's happening here in DFW in November. The last couple of years it's been in Austin. We're bringing it up just for y'all in DFW. We will have some real estate tokenization panels there, as well as all myriad other sorts of digital asset conversations. So you can scan a QR code to find out more about it.